Let's bring in Max Kettner, HSBC's chief multi-asset strategist, to talk about this close. Max, you know, I sit here, the S&P 500 at 6142. It's a couple of points from the closing high from February 19th. Does it make sense that we're back here?
Yeah, I think it does. It absolutely does, because when we look at the earnings picture, that actually does really still look resoundingly good. And when we look particularly at forward earnings, when we look at Q2 earnings expectation, it is actually bizarre to me that consensus is looking for a quarter-on-quarter drop now in the Q2 reporting season relative to Q1. So when we look at that, you know, consensus is saying we're going to drop from around $63.50 down to $62.50 down in Q2. That creates a massively low bar to beat. And even in tech, earnings are expected to just remain flat quarter-on-quarter. Let's remember that, particularly with the weaker dollar, you know, the Magnificent Seven, the seven mega caps make around 60% of their revenues outside of the US. So that really should support particularly the tech earnings, particularly the mega cap earnings going into July and August. And that actually could lead us to even more all-time highs, I think, going forward.
So then, if investors have the luxury of being mostly able to focus on the corporate fundamentals, you talked about the earnings growth. Obviously, corporate credit conditions are quite strong at this point. That would be great, I suppose. But I guess, to what degree are you confident that we've been able to set aside things like the tariff threat, which remains open-ended to some degree, and then, of course, all of the other sort of policy flux out there?
Yeah, look, I think we can take that from both the bearish and the bullish side. Unsurprisingly, I'll take that probably more from the bullish side. You know, one of the bullish things around this is what we face right now is this classic textbook-like wall of worry. You just mentioned tariffs, right? We've got the 9th of July deadline. We obviously also have the 12th of August, the US-China deadline. Perhaps, you know, in August and September, what could keep investors quite cautious as well is any sort of possibility of a failed bond auction and treasuries. Then, of course, in the second half, the narrative goes that, in fact, maybe we'll see some reversal of front loading of activity, which keeps activity quite strong in Q2. So I would argue what we're seeing right now is very subdued positioning, very subdued sentiment, precisely because of all these elements in the wall of worry that we need to climb. What I haven't seen personally yet is that, you know, we're climbing by almost 25% from the lows. We're almost back to an all-time high in equities, and our positioning framework is still nowhere near sending a buy signal, and in fact nowhere near signaling neutral. It is still sending a buy signal, and that really is positive.
Yeah, and there's no doubt that many professionals feel as if they need to chase this thing to get their exposures back up. How does the Fed fit into this framework? I mean, if you say things are great and markets are at a high, there's still a drumbeat for saying that the Fed is too late. How does that fit in?
Look, I think, you know, I would be worried about higher yields. There is a narrative, of course, that, you know, if growth is too strong, doesn't that hurt equities and credit spreads and valuations across the board? Because obviously it might keep the Fed a bit more hawkish. But let's remember, the outlook for the Fed for risk assets is pretty much binary. As long as they tell us, look, in the next 6 to 12 months, the next move is going to be a rate cut, that's totally fine for risk assets. And that, you know, that's very likely going to continue. They're not going to tell us that they're going to stop now, because of course inflation is on this generally pretty supportive path downwards. And on the other side, when we look at yields, you know, I would be more concerned if the 10-year was, you know, well north of 4.5%. The level that we've identified where really it starts hurting risk assets is still around 470, 475. So you could argue we're a good 40, 50 basis points away from that. So even if we were to get an upside surprise on tariffs, on inflation, maybe even on activity in the next couple of months, it will take an awful lot of upside in yield until it really starts hurting risk assets. Until then, it's really game on for risk assets, for equities, for credit, for pretty much the whole risk asset spectrum.